Hey everyone, happy Thursday, May 28th. It's about 10:30 in the morning on the West Coast and it's time for another market update. The war or the conflict, depending on how you look at it, with Iran has reached, I think, 3 months as of today. I believe it started on February 28th. And as can be expected, the markets are still all over the place. It seems like, depending on what day it is, I'll wake up one day and there's news of a peace deal and things are going to go through and the strait's going to open back up and the markets are popping and oil's coming down, which is good for rates. And then the next day we hear that maybe there won't be a deal and that I think, over the last couple of days, there's been some strikes back and forth exchange between Iran and the United States. So that obviously spooks the markets because then they think, well, now there's not going to be a peace deal and there won't be oil flowing freely. And so oil prices spike again. So, really, I would advise for everybody to just kind of wait and see what happens. But we know the markets don't work that way. The markets are trying to get ahead of things, and as soon as any sort of news comes out, they're reacting, which kind of leaves us in this situation where, depending on what news comes out, the markets are going one way or the other. So all over the place. Won't probably get a little bit more settled until they figure out what's going to happen there, and the strait opens back up, and there's no more worry about the war breaking back out open. But right now, it's still the main driver in the markets, and it's still keeping things very volatile and the attention away from data. And there was actually a lot of data over the last week. So let's get into that. Starting with the April PCE inflation report. That came out today, and it actually came out in line with expectations, maybe slightly better for us, a little bit lower numbers than were expected because, especially the CPI numbers a couple of weeks ago were higher than expected. As you can see here, the headline was up 0.4% month over month. The core, which takes out food and energy prices, so try to take out some of these items that are being affected by the war, went up 0.2%, leaving them at 3.8. And you can see on that graph, there's a pretty big jump going back to February when this conflict started. And same thing on the core, pretty big jump starting there in February. So one thing I'd like to point out on these numbers that came out that's not on this graph is that the personal savings rate for Americans dropped from 3.2 to 2.6%. So that's a sign of Americans not being able to save as much money out of their paycheck every month and having to spend more on gas and all these things that have gone up in prices and inflation. So again, not necessarily the best sign for the economy when we're not able to save as much, because if we can't save, well, we have to spend our income on necessities like gas and food and things like that, then we don't spend on other things, and other things tend to drive our economy here in America. We're very good consumers, and when we're not consuming, our economy tends to slow down, which takes me to the second thing that we got today, which was the second reading of the first quarter GDP for the United States. So when they came out with the first reading a couple months ago, it was at 2%. So they were showing that growth in the United States in Q1 was about 2%. However, they did another look at it. They adjusted their numbers and came out at 1.6%. So that fell. So it's showing that our economy is slowing down. This really would have been before anything to doing with the conflict with Iran. So again, not necessarily the greatest sign to see this slow down. Oil prices are always going to affect things. Generally, they don't have a huge effect on GDP, but if inflation stays elevated for longer, the GDP tends to drop because, again, people start cutting costs, not spending as much money, and that tends to have a pretty big effect on the global economy because, like I said, we're all consumers. And we need to keep consuming to keep this economy marching forward. So again, PCE in line with expectations. GDP a little softer than expected. These were actually positives for the bond market. Again, these are the kind of things that the Fed looks at and thinks that, hey, maybe we should cut rates. People aren't able to save money. Our economy is slowing down. That's generally when they would cut their rates to stimulate the economy. So that is a positive thing. And again, the war with Iran, or the conflict currently, however you want to describe it, continues on with new news dropping every hour, it seems like. Next thing. So we got some April home sales data. First one we got was for pending homes. So pending homes, current sales pace was about 4.02 million. It's at up 1.4% month over month, and it's up about 3.2% year over year. Again, not as high as we'd like it to be, but it's good to see that this is ticked up. I think it's 3 straight months that this has gone up. The previous 2 months could have had to do with rates and rates being a little bit lower, but this month would have been when rates had gone higher in March. So it's good to see some resiliency out of the housing market. This time of year tends to, we tend to get more activity. It's the spring, into the spring selling season when people tend to list their homes and to move into new homes. But with everything going on in the economy and rates being higher, there was some expectations this would be a little bit lower. So it was good to see, like I said, some resiliency in the housing market, to have a positive number and to be up year over year, even with everything going on. The next housing data number we got was actually today, was new home sales data. And this was a negative one. This came in at about negative 6.2% month over month. Now they're down about 11.3% year over year. The median sales price jumped. Again, we talked about this last time. That has to do more with not them giving concessions and things like that. Just the mix of homes that are being built by builders, that definitely goes into that number. And then you see down here the stage of construction. There's about 489,000 homes you could buy out there that are new homes, but some of them are just dirt. Some of them haven't even been started. About 111,000. About 256,000 of those are actually at some point in construction, and then only about 122,000 of those are complete. So again, obviously, a lot of this has to do with what's going on in the country and rates and our economy and things like that. So rates higher, you would assume that signed contracts would go down and sales would go down for new home builders. Next thing we got was March appreciation. So appreciation tends to lag a little bit. And this we're looking at here is the Case-Shiller. This is considered kind of the gold standard for appreciation in this country. So this it captures everything basically. And seasonally adjusted, it was down. You see that graph on the negative side, down 0.2% month over month. Non-seasonally adjusted, it was up. Year over year, it's still up 0.7%, but definitely trending lower. And again, a lot of this has to do with rates and things like that. It'll be interesting to see what happens when we get the April numbers. Rates would have been higher, but at the same time, like we talked about this, we tend to see more activity this time of year. So it will be interesting to see where appreciation goes, where home prices went in the month of April once we finally get those numbers. In June. Like I said, these numbers tend to lag a little bit compared to some of the other stuff we got. But good for homeowners, that's still positive. Not good for homeowners that it's starting to drop. Next thing, so where does that leave us? The average 30-year conventional today is at about 6.59%. Last week we were at 2 weeks ago we were at 6.55. It jumped up to close to 6.7. I think it actually got to 6.7. So we've gained back some of that loss. But again, there's a lot of volatility out there. I could finish this video, and as soon as I get off, there could be news that the war or the conflict, they've signed their peace resolution, the strait's going to open up, and you would see rates drop a bunch. You would see the markets pop. You'd see oil drop, and rates come down with it. I could get off this call and see that more missiles were fired and things can go the opposite direction. So going to have to wait till that volatility is out of here to kind of get a better idea what's going to happen. But upcoming, as far as stuff we got coming up, we got the BLS jobs report the first week of June. A few days after that, we get the CPI inflation report, and then the Fed meets again, which will be Fed Chair Warsh's first meeting he preside over on June 17th. Right now, the markets are saying no cut. They're going to keep things where they're at. But again, like we know, a lot of things can change for good or bad between now and then. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.